Okay, intermediate accounting. Welcome to the first lecture video. This is on chapter 18. Chapter 18 is on shareholders' equity. I believe we got through with chapter 17, but honestly, it's been so many weeks now. I read through chapter 17. I felt like I lectured on either all of it or most of it. If I missed something, email me and let me know. I will be using some PowerPoints. I'll also be doing spreadsheets and things too. The beginning of chapter 18 is all just kind of informational and just kind of examples, and I won't be doing any problems. So for that, I'm going to go ahead and use the PowerPoint. Okay, so shareholders' equity. We'll talk more about that. So there's two different ways that companies can get financing, meaning basically money or capital from the outside. There's debt and there's equity. Okay, debt is things like not limited to, but for example, bonds or debt, loans or debt, all different types of things. Anything that creates a liability effectively is debt. Equity is the other method. This chapter focuses on equity. We've dealt with liabilities quite a bit already. That's been the last several chapters we've looked at have been about liabilities. So that's kind of already been covered. So equity is kind of the next step in the lecture series or in the chapters here. So shareholders' equity is assets minus liabilities equals equity. Now that's not the way we usually show the accounting equation, but if you mathematically look at that, it's exactly the same equation. We just moved it from one side, moved part of it from one side to the other. So the difference between my assets and my liabilities equals my shareholders' equity. I'm sorry, I'm not used to these PowerPoint slides yet. Okay, ownership interest. Okay, the shareholders' equity section has two main components. We have the paid-in capital and the retained earnings. The retained earnings, we're talking about money that we have earned and kept, meaning we have not paid it out in dividends, but it has been earned. It comes from net income, hence the phrase retained earnings. And paid-in capital is money that comes in from the sale of stock. So selling our stock, and remember that's only on the primary market. When I sell it in the first place, this isn't transactions between owners. On the secondary market, it's the transactions between the company itself and external shareholders. So you can call it a few different names. Shareholders' equity is the one we kind of use. You could call it stockholders' equity, shareholders' investment, stockholders' investment. Those are the different companies and the different names they use, but we're always talking about the same thing. It's all still equity. Okay. This is illustration 18.1 in your book. It's on page 1037. Shows what the shareholders' equity section looks like. We have our paid-in capital. Notice that when we have paid-in capital, we differentiate between different types of stock. We differentiate between, if there's bond conversions or stock options or restricted stock. So while there is really only two sections, there is more detail than there's not just two lines, unless it's a really simple company. There's usually not just two lines involved. There's usually substantially more than that. And we're going to talk about a lot of these throughout this chapter and the next few chapters. We'll talk about the difference between preferred and common stock. We'll talk about the difference between how stock options work. We'll talk about the accumulated other comprehensive income as well, the unrealized. Actually, we talked about that a little already, but the unrealized holding gains and realized loss and gains on pensions and derivatives. Won't talk about too much. Foreign currency translation won't talk about too much as well. Okay, this is a typical shareholders' equity presentation. It's kind of what it looks like. Starts with preferred stock, lists what that stock is and how it's paid, whether it's cumulative, whether it's participating. Cumulative means that it accumulates when we pay them first. We'll talk about that again later in the chapter. Non-participating means they do not vote. Okay, common stock usually does vote. Most often preferred stock does not. There can be exceptions, like there's everything, but generally speaking, preferred is non-voting, non-participating, and common stock is voting. Additional paid-in capital, that number comes from the difference between the par value of our stock and what somebody actually paid for it. So if I have a $1 par like the common stock there, let's say, just for the sake of argument, that we sold, looks like 60 shares of stock, but we sold it for $400. Well, then $60 would go into the common stock because the par value goes there, and the remainder, the additional paid in capital, the difference between the 400 and the $60 par value is what the additional paid in capital. We have our retained earnings, which in this case is a given number, because remember that comes from our net income, comes from our net income and all prior net income that we haven't paid out in dividends. And then we have our accumulated other comprehensive income. And like I said, we've talked about most of those already, investments and pensions, but not derivatives, so we probably won't. Then we have treasury stock. And remember, treasury stock is stock that I have bought back from the market. So if you ever heard the phrase stock buybacks, that's usually what we're talking about. All right. Excuse me. So shareholders' equity has those main components: paying capital, retained earnings, treasury stock, and accumulated other comprehensive income. Okay, paid in capital consists primarily of invested amounts by shareholders when they're purchased shares of stock from the corporation or arise from the company buying back some of those shares. So arise from buying treasury stock back. Okay, so it comes from one of the two. Okay, either selling shares or from, and also, by the way, the third one is it can come from share-based compensation activities. Usually we're talking about stock options there. Retained earnings, on the other hand, earnings accumulated on the shareholder's behalf, not yet distributed as dividends. And treasury stock is shares previously sold to shareholders that are bought back by the corporation. Okay. I would pause the video here. I would read this question. I would answer it. I'm going to move quickly through it, but I would recommend quizzing yourself as you go through. So the answer to this question is B. The cost of the cost of shares previously sold to shareholders that are bought back by the corporation. What is that? That's treasury stock. Okay, accumulated other comprehensive income. This extends our view of income beyond our net income reported in an income statement to include 4 types of gains and losses, not included in the income statement. The overall purpose of accumulated other comprehensive income is the changes that have occurred based on irregular elements of our financial statements. We like our income statement to be something that we can use to estimate as best we can the future of the company. We like it to have, prophetic's the wrong word, but be able to judge the future of the company off of it. And things that go into other comprehensive income are things that are atypical or not happening frequently or not anticipated to happen in the future effectively. So net holding gains and losses on available for sale investments and debt securities. We talked about that when we talked about securities. Gains and losses from amendments to post-retirement benefits. We talked about that in chapter 17. Deferred gains and losses on derivatives. That's one we won't cover in here, but it's another gain or loss on derivative financial instruments. And then adjustments in foreign currency translation. Another one we won't necessarily cover in depth in here, but it's the other fourth element that can go into accumulated other comprehensive income. Okay, so we report 2 attributes of other comprehensive income. And I'm on page 1038. Sorry, I'm trying to do a better job of keeping up with that. I'm 1038 right now, underneath of accumulated other comprehensive income. So the components of this are created during the reporting period in the statement of comprehensive income. The comprehensive income and accumulated over the current and prior periods on the balance sheet. So we have other comprehensive income, OCI, that goes on the bottom of the income statement, which you can see here in the picture below. This is showing a partial income statement. So you got net income there at the top. That's not the beginning of the statement. That would be the last line of the regular income statement. So this is just below this is actually in addition to the income statement. This goes on, tacks on right at the end of the income statement. Whereas the accumulated other comprehensive income instead goes on the balance sheet. There it is, the last line there on the balance sheet. And effectively, that's an accumulation of all of those other comprehensive incomes from prior periods. And this is the stockholders' equity section from Walmart for what year it said it was. This is on page 1041 of 2013, 14, 15. Oh, yeah, it says right there, yeah. 2014, 15, and 13, 14, and 15. Okay, and it shows the total. And this is just another method, but notice it's giving pretty much all the same. It is giving all the same information that we had before. A little bit different way that it's laid out. Instead of up and down, it's more across. But it still is giving you the same details. As a matter of fact, probably giving you a little bit more details than what the prior method did. Notice also it's comparative because you can see 3 years in one statement, which is also nice, where I can see where it's going, where it's headed, and where it's been. Okay. IFRS, the International Financial Reporting Standard. You, again, usually just need to kind of know the difference. I don't usually give you much homework or tests on IFRS, so much as it is kind of important to know there are differences. If you ever work for an international company, you kind of start with what you know with GAAP, and then you say, okay, how does this differ for IFRS? So that's all this is showing here. And that's on page 1040 of your book. Okay. And again, I would recommend quizzing yourself and pausing and see if you can answer this question. There's nothing wrong with getting it wrong if that happens, but so I'd pause here to do that. And the components of other comprehensive income include C, it should be C, yeah, gain on sale of equipment. Okay. Again, you can pause here to look or to answer the question. The reevaluation reserve. The answer. Okay, so now we're going to talk about different types of organizations. This starts on, we talked mostly just about corporations right now. Pretty much all we've talked about. The book is a little misleading in the way that it says that, you know, corporations are the first one and main one we talk about because they are, it says, well, I guess it's not misleading, but it calls them the dominant form of business organization. So the truth of the matter is they're dominant because they make up most of the economy because the largest companies are corporations. So anything you see publicly traded, they're C corporations. Any big, large organization that is, you know, of substantial size, usually you're talking about a corporation. There are obviously large private corporations. You know, Koch Industries is a large private organization, and Cargill is another large private organization. But generally speaking, they say it's dominant mainly because it's dominant in the market. Okay, the largest companies are almost always C corporations, but there are other hybrid corporations. The good news is, other than a little bit of change in terminology, the difference between how we account for these companies isn't substantially different. Partnerships can get a little strange, but generally they're mostly, you know, as long as you know the general rules. That's why it's important to know these things conceptually rather than just like being able to do a problem, is because if you know conceptually what you're doing, then it can be easily translated, even though it's a little different, to other forms of organization. So an LLC, a limited liability company, is a corporation that's a separate legal entity responsible for its own debts. The owner is not personally liable for debts of the corporation, which is good because effectively what that means is that the only money that you can lose as an owner or shareholder is whatever you invest. So you put $100,000 into the company, it doesn't do well. The only thing you're at risk of losing is that $100,000, not at risk of them coming to take your personal belongings. There are exceptions to that. Some people use their personal belongings as collateral. If you do that, then obviously if you're collateralizing, then that's going to be a problem, and they can take it at that point. Corporations sell ownership interest in the form of shares of stock, and hence the ownership rights are easily transferred. One of the positive or advantages of a corporation is that they are easy to change ownership, buying and selling it. Okay, disadvantages of corporation: they're heavily regulated by the federal government. They also pay income taxes twice. I think I've talked about this a lot of times in class, but the fact of the matter is that the corporation pays tax themselves, and then if they pay dividends out to the stockholders, that same money is paid tax on again. Not-for-profits can be owned by the public sector. I actually don't like that owned. It's more run. Not-for-profits don't actually have owners because there's no shareholders. So the governmental unit is who operates it and who has the power. So let's say you went out and started a not-for-profit, you would be on or be the head of the board of directors. So you could be the president, the CEO, but you wouldn't be an owner because there isn't ownership rights. in a not-for-profit organization. So there's some examples. Corporations, as I mentioned, can be publicly held. This means stocks are traded on the public stock markets, or they can be privately held. Like I said, the examples of Koch Industries and Cargill, two of the largest ones, two of the largest privately held companies in the world. Okay. Okay. An LLC, a limited liability company. Maybe I skipped ahead earlier. Maybe it said corporation. Corporations have limited liability as well, but so does an LLC, which is a hybrid organization. I think I misspoke on the prior slide. I apologize. But a limited liability company is the same thing where it separates the personal assets from the individual from whatever they invest. So they can be involved in managing it, they can run it, they can invest, but that's the only thing you can lose. Their liability is limited to their investment. Income and expenses are passed through the owners, avoiding double taxation. LLCs are not taxed at the LLC level. They are only taxed at the individual level. So if your S corporation or if your LLC, both are hybrids, makes $200,000, it doesn't get taxed at the LLC level, and then when you pay yourself a dividend, it gets taxed again. Instead, it's taxed one time at the individual level the year that you actually make the money. And there's no limitation on the number of owners. There's also limited liability partnerships, similar to LLCs, except for partners are liable for only their own actions and not liable for the actions of other partners. I'll let you read through the corporate charter part. And this is something I already talked about, but common shareholders have the right to vote. They have the right to share in profits when dividends are declared, but they are second to preferred shareholders, meaning if there's only so much dividends that are offered, we would pay preferreds first and then pay common second. And they also have the right to distribution of assets if the company is liquidated, like in a bankruptcy. If you're getting rid of the organization, then if things are being sold off, then you as a common shareholder have rights to some of that money. They also have preemptive right, the right to maintain 1% share of ownership when new shares are issued. So that means if you own 10% of an organization and they decide to issue new shares, you have the right to purchase enough to maintain your 10% ownership right, or 10% ownership in the organization. If more than one class of shares are authorized, then specific rights of each must be stated. There can be class A, B, C, there can be preferred common, and class B, preferred common, and these are just different companies that do different things. Preferred and common are kind of the main two we talk about. Usually the two differentiation is between preferred and common shares. So preferred shares usually include one or both the following. If the board of directors declares dividends, preferred shareholders receive the designated dividend before any dividends are paid to common, which I mentioned earlier. Preferred shareholders customarily have a preference over common shareholders as the distribution of assets in the event of corporation dissolving. So preferred not only gets dividends first, they also get in liquidation. They also are paid before common shareholders are. Okay. I'm going to stop there. It's a good stopping point in my video. It's almost 20 minutes now, so we'll be back. That is, we stopped here about the point of 1045. So we'll come back with another video to continue.